Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year.
All right, folks, you're on the Property Couch. Each week, Ben and I bring you the insider's guide to property finance and money management. Oh, isn't it a good time to be in Melbourne, mate?
Finals!
AFL finals, I know.
Right. Our team's out. My team's out. When did your team fall out?
Oh,
A little bit.
Oh, you're gloating just because you lasted a week longer. I thought this was a game.
We should have been a couple of goals up at half time. There would have been a little bit of pressure on the Tiger. You know, the Tiger team.
See how these rules change, Ivers? I know, they just spin
Anyway,
out.
we're both out.
Hey, very, very special guest today, but obviously sending out a cheerio to our Richmond-based listeners and also our Adelaide Crow-based listeners.
Yep, good luck.
May the best team win.
There can only be one.
Who do you reckon? Tip?
Adelaide probably.
Yeah.
I'm
going to go for Richmond.
Yeah, I mean 35 years or something like that. But see, I still have problems. You know, they beat us in the 1980 grand final and still haven't got over it. So it took me a while.
Showing your vintage there, old boy.
I know.
But before we get to our very special guest, of course, I think there's another big game going on this weekend, Ben. And
my favourite game.
And Melbourne Storm is
dominating.
Storm, hey?
Go the Storm.
And we said to Ivers, do you know who they're playing? She goes, yeah, the North Queensland Cowboys. Which is, of course, the North Queensland Cowboys. So
yes,
thank you for that.
And they've come from, I think, 8th, haven't they, to make the grand final.
Oh, now you're looking knowledgeable.
So, I'm probably wrong, but I just made it up. But yeah, you know, so, and there's no, what's there?
Yeah, come on. Yeah, too many interviews for you today.
Oh, too many things on.
This is going to go to air, you know.
No, it's not. What's his name? Oh, the best player for the Cowboys.
Oh, this is
the one who handed
if only he knew Jonathan Thurston's name was. But this is the bit where Ben needs to eat more grass, Ivers, because then his brain would function better than what it is now. Captain Pie and Chips, it's not working real well, is it? But Jonathan Thurston.
Jonathan Thurston, that's right.
Yeah.
The guy who wears the helmet.
Yeah, helmet.
There we go.
The superstar. State of origin.
Superstar.
Yeah. And what's your point
he's
here? He's out.
He's out.
Oh,
well. The bugger's out.
Oh, well, Melbourne Storm. They must have given them
well, they got to the grand final last year against Cronulla and got beat.
Special
so there's a little bit of, come on, Storm.
But, mate, we digress from a very, very special guest today. Because we've got Pete Wargent, who's joining us today, which is going to give us some enormous insights. But, Pete, we normally do the Mindset Minute at the top of the show. But I asked you if you had any sort of quotes or themes that you live your life by, and you actually gave me the nod and said, yeah, you do. So let's kick it off with you.
Yeah, well, g'day, boys. Good to be here. I think, it's no secret I'm a big fan of Tony Robbins, and I think the principle that I absolutely love that he espouses is Kaizen. It's a Japanese word that we don't really have an English equivalent, but it's I suppose the best translation would be a constant and never-ending improvement. Mm-hmm. And I just love that because I know you do life hacks on this show and they're great, but it's stuff that you can just continually improve through your life. And looking for little things you can improve the quality. You know, we talk about compounding and investing, but compounding the quality of your life as well. I just love all that stuff.
Man, I love it. Kaizen. There you go.
Kaizen, yeah. And it's adopted in businesses over there in terms of the total quality management and bringing those principles back about that constant improvement. So, you know, there's lots of business studies around how some Japanese companies forecast 50, 80, 100 years in advance in terms of... Now, I think that's extremely hard to do with the advancement in technology, but that's the principles. And they have these extraordinary long meetings and they sit there and they debate things for 13, 14, 15, 16 hours before they come to a conclusion. We get upset when our meetings go for more than 45 minutes. Well, right, I'm bored now. Let's move on to the next thing. But it's all based on that Kaizen principle.
Well, Pete is a chartered accountant, chartered secretary, has a financial planning diploma. He's achieved financial freedom at the age of 33, which is detailed in his book, Get a Financial Grip, A Simple Plan for Financial Freedom. Pete now manages his investment portfolio, travels and works as a consultant in the finance industry from time to time, and by the sounds of it, spends a bit of time at Tony Robbins seminars. So officially, welcome to the Property Couch, Pete.
Thank you. Good to be here.
Have you done any of the Tony Robbins seminars?
I actually haven't. A good friend of mine, Stephen Ryan, who you might know from some of the property magazines, he was there at the Gold Coast a couple of weeks ago, and he talks very highly of them. So one day.
I'm a big fan. You haven't done the firebook yet, have you?
I've done the books, and I bought the courses, and I've done a few other things, but I haven't done the one on 1,000, or 1 on 5,000, which is what Anthony does these days.
Yeah, well, he gets a few in. There's a really good one on Netflix. Ben and I have checked it out. I'm Not Your Guru. I don't know if you've sussed that one out, but if you're a Tony Robbins fan, that's actually really good.
Yeah, it's terrific.
It actually demystifies some of the hype that surrounds him. Just thinking that he's a fire-walking sort of what's the word? Just rah-rah guy.
Yeah,
There's actually
motivator.
There's actually a fair bit of substance that goes behind what he actually does, and then lets the crowd sort of watch what he does in action and see how they can relate it to themselves, and then maybe empower themselves, which is really good.
I was travelling on a plane internationally back in my old tourism days years ago, and I got an upgrade into business class, and I'm sitting in business class with this guy next to me, and I've got maybe an Australian property investor magazine or a magazine or something like that. I'm flicking through, and he goes, "Oh, you're interested in property, eh?" He said, "Oh, look, yeah, I am." And this is before I set the business up. He goes, "Oh, I do a bit of property." I said, "Oh, what do you do?" He goes, "Oh, I've got a couple of pubs in Melbourne." And I said, "So, is that your main business?" You go, "No, I'm a pig farmer." So here's this pig farmer, and I'm sitting, "Oh, okay, so where are you going?" "I'm off to Italy for 10 people with Anthony Robbins." So he paid $250,000 to go and spend basically a week with Anthony Robbins in Italy somewhere to do. And so the pubs turn out to be like hotels with 200 rooms in them. His pig farm apparently is one of the biggest in Australia. So I'm sitting next to this guy telling me the story. "Oh, I do a little bit of property." So it's about to talk. That's my Anthony Robbins. So that's as close as Anthony.
Yeah.
So he was in that. I think Anthony has about 50 people that pay him that type of money back in the day, going back 20 years ago, that were doing that type of thing. But there you go. I mean, that's how much people are willing, and that's the value they see in spending time with him. But as he says, he's not. I think the name of that Netflix doco is terrific because he isn't a guru. He's just giving you some frameworks. And what I love about some of the new stuff he's building out and this journey that he's going on using the Kaizen principle, I really love that he's looking for this pursuit of happiness now, and he's saying that financial stability will bring some of that. So he's obviously going off into finance and sort of they've got the index fund that he's setting up over in the States, and he's doing that sort of unshakable stuff. Yep. And he's got the money book, and all of that is about basically saying to people that it won't bring you happiness, but a level of wealth will bring you some level. Whether you got, I think it was about $50,000 or something like that. If you get anything over that, it doesn't materially change your level of happiness. Have you done any work on that, Pete, in terms of you done any study on that sort of stuff?
Yeah, for sure, and I think that's well known and well proven. And it's the same in the workplace. They often say that money can be a motivator up to a certain point, but job satisfaction beyond money, it comes from all different types of things: acceptance, respect, sense of achievement, and it's exactly the same in life too. As you say, I think having a sense of financial stability obviously can bring people a certain level of happiness, but then you go back to the hierarchy of needs, there's much more to it than just that.
Yeah, and if anyone doesn't know about Maslow's hierarchy of needs, just Google it, and it's so simply and beautifully put in terms of how we go through life, because in some cases we do find ourselves drifting off. What's the purpose? Why are we here? You'll get those moments. Just bring it back to that, and understanding that if you can find purpose in the things that you do and take a real interest and get connected into those things, you can have a fulfilling life. And it doesn't all just have to be about the money story.
Well, speaking of Tony Robbins, he's got the 6 core human needs. He's one of the most watched TED Talks, so you should check that one out as well. But I always come prepared, Ben. My Mindset Minute theme was going to be Zig Ziglar. You don't have to be great to start, but you have to start to be great.
Yes,
that's
a cracker.
With that in mind, you reached financial freedom at the age of 33. Where did you decide to start in the game of property investment, and how did you arrive at that decision?
Yeah, I think in terms of actual property investment, it was my wife that got me into that. So when we met, she was a property investor already. Now, my background is a chartered accountant in London. We tend to gravitate towards what we feel most comfortable with. Part of my job, especially when I went into industry as a Group FC, was writing annual reports for listed companies. So I obviously felt my strongest suit would be fundamental analysis, value investing, and the share markets. But it was when I met my wife, I could only respect the results that, as you know all too well, the combination of leverage and compounding and investing in top quality locations. So she, her first property was in a place called Cambridge in England, which is the only market that's actually outperformed London over the last 20 years since she's owned it. And that actually got us thinking that maybe we should replicate that. So the markets that we targeted were Sydney initially, and then the inner ring of Sydney, and also London. And those markets have been very kind to us over the years.
Very kind. They've been fantastic and well researched to understand that. I mean, there's a lot of different ways in which you can slice out a strategy in property investing, and you've gone to the fundamentals and the basics around that, haven't you? So when you talk about value investing and fundamentals, what are some of the things you're looking for, and your wife for that matter, credit to her, that she was trying to identify in terms of buying these properties?
Yeah, so my wife Heather, I mean, her parents and her family, she's from a farming family, so it was well ingrained into her from an early age that you don't spend the excess money in any given year, you reinvest it for the future. Ideally in land where possible. This is a bit of a did you know for you, but in the UK, farmland is inheritance tax free. So it's obviously become, over the last decade, it's become a phenomenally popular investment vehicle for people. I think a lot of people are posing as farmers. I won't name names, but some very well-known billionaires in the UK have been mopping up a lot of farmland. But yeah, the principles of compounding, she was well familiar with. I think, being honest, hand on heart, when we started out, I didn't really know very much at all about property investment. I don't think back then, at least as far as I knew, there weren't the books available that there are now, or at least I wasn't aware of them. So I was very much working on the principle of, well, these are the kind of areas that I would live in, and therefore other young professionals and people like me would be thinking the same. That said, I did learn some important things from London and the transport links. We know in London, if a property is within a 5 or 6 minute walk of a tube station, you can instantly add a 25% premium. So we've always followed those fundamentals. So the first property I bought actually in Sydney was in Bondi Junction, following that principle really. It's 10 minutes to the CBD, walk to the beach. I wouldn't say I knew very much about property investment, but it was common sense.
What was it, a terrace, a townhouse?
100 square metre apartment. So we've still got it. We've never sold a property, so everything, all our good and bad investments are still there in the portfolio.
That's all right.
But I mean, as I say, I think looking back, I've made a few amateur mistakes, overpaying potentially. I've bought a property with a special levy. I've done all of those things along the journey. But if you buy in the right types of locations, then certainly the places we've invested in Sydney, like Darling Harbour and the Inner West, they're very forgiving over time of small mistakes like that.
And in terms of density, Pete, was that playing on your mind when you first started out in terms of medium and high density versus smaller density? Like, because London is obviously capped in terms of height parameters, so you do have, even though there's plenty of sky, the way in which the town planning is quite restrictive in that sense. And for those people who have been to London, one of the best cities in the world, there's certain pockets that are now allowing a bit of high rise to sort of go in there, but predominantly, is it 5 or 6?
Yeah, it depends on the borough, but I mean, as you said, London has never embraced high-rise living. There are some city buildings now that are going up, that some of
in the finance district.
And some of which have some residential around the South Bank and so on. But as a general rule, it's a low-rise city, and therefore the supply has literally never kept up with the demand. And population growth, a bit like in Australia, when people come to the UK, they go to where they know and where their friends are, where the jobs are, and London mops up a big share of that. So the supply has never kept up in London.
So the Bondi, was it in a medium or high density, or was it in a small rise?
It was in a medium density block.
Yep.
I think the other thing about when you start out, and it was a bit easier back then because you could use mortgages with not too much in the way of a deposit. Whisper it quietly, but to some extent you can only buy what you can afford when you're in your early 20s, and you just do the best thing that you can at that point in time. Although I've been a capital city investor, there have been ways along the journey where I could literally only afford to invest in a regional city. So I've got properties in Geelong and some of the UK equivalents in the commuter belt of London, because in an ideal world we'd all have perfect portfolios, but at some points you can only do what you can afford to do.
Yeah. So you use yield as part of that story. So it's true when we're building out portfolios here, we're sort of obviously focused in on, if we've got the surplus, we'll go after the gold. But if we don't, we might have a couple of cash cows or balanced assets, as we like to call them, in the sense that the yield is sort of covering up to be able to, at least, it's better to be in the game than to not be in the game at all, and adding to that portfolio. So that sort of makes sense to me.
Australians are starting to get used to the fact that Sydney and Melbourne are considered world cities. So what can the listeners learn from your experience being in a world city of London, and what you take for granted over there being in a world city that maybe Australians haven't thought about as us being a world city, and how that will impact on property? Yeah,
so there's some different things about the London property market. So and listeners may or may not know these bits and pieces, but there have been no restrictions on foreign money. So certainly in prime central London, it's like a big hotel at times. It's very much foreign capital from Malaysia, Russia, China, you name it.
The Arab Emirates.
That's right. Now, I know a lot of people would say in Sydney and Melbourne that's the case in some pockets, but there are actually rules about what foreign and non-resident investors can and can't buy. But the thing, I've done a lot of research into this type of thing, as you know, and one of the things that we've seen from global experience is that when a city gets beyond about 5 million people, livability becomes a serious challenge. Sydney went through 5 million in the last year. Melbourne, at the current rate of growth, is going to be there very quickly. And that's when you find that transport hubs and transport links suddenly become of vital importance. And I think if you speak to some property managers in Sydney's Lower North Shore, for example, they're already saying that you're getting a 2-speed rental market in places now, because people need to be able to get to the CBD, but if you can't drive very easily, then being stuck out away from a train or bus link or a ferry link, it becomes very difficult. So that's certainly one thing that from London, hardly anyone I knew owned a car because it just wasn't worth it. And there's a whole list of things. I mean, I'm a bit wary sometimes of people drawing comparisons between international cities, because there are different tax rules and all kinds of differences between them. And the Four Corners type show will always compare prices in one city to another. But one of the things that has changed in London, even in the last couple of years, we've had tax changes for foreign investors. So we've got withholding taxes, now capital gains tax. We've also got a limit on deductibility for investors, which is something that Australians have always felt is sacrosanct. But in the UK now, you can't even deduct the full amount of interest. So things like that, which people always thought could never change, have changed. So I think that could be a warning shot for some Australian investors to be prepared, because things can and will change over time.
So it's fascinating. I mean, I look at what's happening with Brexit, and I suspect with the pound going lower and the potential yields that you're seeing in some of those markets, and you're talking about Cambridge and certainly up through that sort of Nottinghamshire area, is if I'm getting it right, and up through Grantham. And my late grandmother lived in Grantham, so I used to every couple of years head up there and have a look around. And it is interesting in terms of, obviously you've got the main arterials and then you've got the rail network, and there's potential in introduction of a higher speed rail that's going up there. Are you, with your buyer's agency business in the UK, are you looking at getting into those particular markets?
Yeah, I think most of what we do is with high net worth, so mostly we'll focus on London. But another of the key tax changes that has come along recently is that there is a very high stamp duty threshold, stamp duty bracket now. So if you're spending over £1 million, you'll be clobbered, and that section of the market has just died a death.
Yep.
So you find that the boroughs that were long outperformers, Kensingtons and Chelseas and so on, those markets, transaction volumes are way down, and they're really hurting now. And the price growth has shifted into the lowest price deciles. So that's a change for people who are looking for pure return on capital. They need to consider now that they should probably be spending in the 700 to 900 range and not going into the top bracket, because the stamp duty is ludicrous, frankly.
So that's 700 to 900,000
pounds. Yeah. So
pound,
the exchange rate fluctuates, but 2 to 1 is the old rule of thumb. It's a bit less than that now. But the other market that we think is an outperformer is Manchester. It's not the second largest city in the UK, but it's a big population hub, and we're seeing a bit of a drain away from London, because it's very expensive, it's overcrowded, and just as Sydney will find in the next couple of years, people start to drift north, and that's happening in London too. Do
you know anyone else who's drifted north from Sydney recently, sort of close to home?
Every second person you meet in New Farm.
Wouldn't be your good self. So you've got offices in terms of your business, you help people buy in London and in Sydney, and now Brisbane, because you've moved to Brisbane. Are you helping Australians buy into the UK, and is there an appetite for it, and what are the barriers that people need to overcome if they want to do that?
Yeah, that's a really great question, actually, and I think you guys would know this better than anyone, because you're strategists, you're not just buyers agents. I very, very often get people, they see the pound has been devalued, they'll send me a link to a property in Chelsea and they say, what do you think about this property? And I should set up an email template to reply to this question, because the obvious answer is, what are you actually trying to achieve? The property is really the last piece in that puzzle. And I often say to people, you wouldn't think it, but as a buyer's agent, I often discourage people from making those decisions, because you're not just buying a property. You're buying a foreign exchange instrument. If you want to repatriate funds, there might be tax implications. There are now new rules for non-resident investors in the UK. So I'm not saying don't do it, but you've got to really think about what is it you're actually trying to achieve. And then the property investment is really the last thing you should be thinking about. But of course, people often think of the property first.
Look, a couple of things. I mean, in the UK, you mentioned before with the farmers, and the land is not part of, but they have a death tax. So if you've got other property and you're deceased, the government will take a clip of the ticket. Now, we don't have death taxes here in Australia, but the reality is that if the government can't stop their spending regime and continue to keep pushing that safety net higher and higher and higher, so this is our risk, that we will certainly see something like that. If we can't address GST, we're going to address something like that. So you heard it here first on the couch, that when you're listening to this in 20 years' time and the governments are trying to argue for a death tax, well, that's because we didn't move on our GST when we should have. And we also, we sort of said to the government, stop spending. Actually teach people to, actually live a little and have a go. Don't try and encourage them or discourage them to basically just say, oh, the government will look after me. So I do get on my bandwagon.
Can't you get Scott to put the government on money smarts?
Well, I'd like to think, the government of the day at the moment tends to agree with me a little bit. I'm trying to be apolitical here, but what we don't want is the safety net being so challenging. But we're run by the voters, the voters' feedback of the day, and we're not vision. We're just I'm getting annoyed, so hence I'm getting frustrated in the way I talk. But Pete, in terms of that, I mean, has there been a big backlash? Obviously affordability has been a big part of that. Brexit, we've definitely seen that bit of it. So where do you see the UK economy? Are we going to see a bottom out, the pound go further down, or what's your view on that?
Well, we've been talking about the rebalancing now for I don't know how many years, and it never really seems to take hold. I think just globally, I think it's a long, slow recovery from what was a serious crisis. I think a lot of people would be interested in that, but obviously being English, I've grown up through recessions, and a lot of Australians can't even remember the last one.
No, that's right.
And we learned some interesting. We learned some interesting lessons from that. I mean, well, one of the things, as you already mentioned, when the UK went into its credit crunch and recession, the pound dropped very sharply, at least against some currencies. And then we saw a whole wave of foreign capital come into the London property market. It wasn't a regional thing. And we maybe saw a 5 or 10% correction in some markets. And the London market has practically doubled again since then. With the low interest rates. Now, I mean, Australia, we've had slowdowns and we've had hiccups, but we haven't had anything where we, double-digit employment and real deep recessions. And Australia's done very well to avoid that. But you do learn some hard lessons through a recession.
Mm-hmm. And sorry, just finishing on that, do you see more of that? Like, are we in a bit more pain there, or not really? Do you think that they're... I mean, look, obviously they want the pound to go down, because that, if they're going to try and take obviously some of those jobs back through Europe back into, more production, manufacturing, more output out of the UK, that's actually a good story for them in terms of being competitive in selling back into Europe, isn't it?
Yeah, look, I suppose the thing with the UK is it's a bit of a paradox. Where the unemployment rate now is the lowest since 1975. And jobs growth it's just been a jobs creating machine, the economy there, for the best part of at least half a decade now. But we just haven't seen wages growth come back, which normally you would expect to see with an unemployment rate down at 4.4%. You'd expect wages to be going through the roof. And that just hasn't happened. And there's a parallel there with what's happening in the US as well. Australia is seeing some of it. We're seeing, even though the unemployment rate has improved, the wages growth in nominal terms is as low as we've ever seen. So that's, I think, probably a bit of a global phenomenon as well.
Yeah, okay.
So keeping Europe in mind, I mean, you obviously got that experience in London. Are there other markets in Europe that you suggest clients consider, or you largely keep them in the bigger metropolises of London?
We only buy really in London and Manchester. I mean, I wouldn't say to people don't buy anywhere. I would just say just really think about what you're trying to achieve. And gee whiz, a lot of Brits went and bought properties in holiday homes in Spain and those kind of areas.
The TV industry based on that.
Well, yeah, that's right. And believe me when I say I know people who've got properties that are worth literally zero. Because if you buy in holiday type locations, I mean, it's not that people were long warned about it on the old TV shows about timeshare apartments and all this kind of stuff, but people are buying not an investment but also a dream and a lifestyle. But the Spanish economy didn't have its own currency, so a slightly different reaction to the downturn. And that was serious. I mean, that's one thing in Australia's favour. And as you know, I do a lot of work with hedge funds and some very intelligent investment advisors. And look, everyone knows about Australia's property market. It's had a great run, but the one thing that Australia has that Spain and Ireland didn't, of course, is a free floating currency, which means that the rebound from a serious downturn potentially would be much quicker.
Mm-hmm. So if I revisit the previous question about people in Sydney, and you said there's a lot of barrier, Australia investing into London, you said there's a few barriers they need to consider. That being said, do you have many people that you do help in Australia buy into the London market, or do you mainly find that your clientele is based
we do
there?
get some. It's mainly been currency driven, I think. I think a lot of people, I mean, when I first came to Oz in the 90s, there were $3 to the pound, and I think people have got that, they benchmarked it to at least $2.50. And when we got down to essentially half that, I think a lot of particularly middle-aged and older Australians just thought this is a real opportunity here. And the types of stuff that we buy, many of the same principles. You look for scarcity, transport links. We've been very active in Greenwich around there, so terraces are very popular. Sort of price range between sort of 700, 800, 900. I think if you go above that now, you'll get really clobbered with stamp duties. But there's some really good investments, and in Aussie dollar terms, it doesn't feel too bad now.
And just finishing that out before we move on, but is there that flavour where they say, oh, and we can holiday out? Like, do they, they try and mix
retire there one day.
they mix the flavours, and when we go over and see some shows or something like that, obviously high net worth people, we'll move
the tenant out. We'll stay there for 2 days.
Yeah, I was about to say it just doesn't happen that way, but they do think that way, don't they?
Of course,
they flavour their investments with lifestyle elements as well.
Yeah, and you get some people who actually just want that. They want walking distance to the West End, the Theatreland, and for some people, it's not purely a financial investment. And I think there are different different reasons for investing, and I think a lot of people, and it's the same in Australia too, they often buy in locations they think, oh, my holiday there, Sunshine Coast being a classic.
Yeah, very true. So you've got a blog. I frequent the blog. Obviously, there's the Twitter and that leads into that. You're for me the king of graphs. There's usually a daily graph that comes through. In terms of some of the charting and the analysis that you're doing, the fundamental analysis that you're doing, what are some of the more important variables or considerations that you're looking for to try and identify a trend and make a conclusion on that?
It depends. It depends on who's the user of the information. I think in particular for people who have been working for recently, some of the world's larger hedge funds in the US, they're very interested in a possible downturn. And I would say the number one indicator is often building approvals. Because people have seen from international experience that we talked about some of those countries, Spain, Ireland, the US, that when you see building approvals dive off a cliff, that can be an indication that people at the coalface are saying, hey, look, we can't make profitable projects work anymore. And that often foreshadows a serious correction. Now, Brisbane apartments, we saw it happened in Q3 last year. We suddenly saw from record highs apartment approvals, not so much the detached house market, but apartment approvals basically halved in no time at all. They still haven't quite found a bottom even now. And that's because the market, as you know, is well oversupplied in certain sectors. So that's one indicator that's always keenly watched. But it depends. If you're a property investor, you might be looking at population growth, wages growth, the health of the economy, all of those things. They all feed in.
Yeah. And back to the Brisbane story. I mean, there has been a couple of prudent developers who have said, we're not going out of the ground, which is good. So, okay, the approval is granted, but they're reading the tea leaves well, and they're sort of saying, well, let's hold off on that, which is a good sign. Coming back to, I think it was earlier this year, the 60 Minutes report, which had a couple of those hedge fund people trying to force the story, so to speak. That was an interesting one where the property market's in a bubble and those types of things. So we can understand that they're looking for opportunities. That's what hedge funds do. So in terms of some of the insights that you were giving to those hedge funds, what you were talking obviously about floating currency and those types of things. So it's a different type of market. I'm sure that they were really interested in the chances of negative gearing changes and capital gains exemption changes. So what was your overall conclusion? What were you sort of telling those guys?
Yeah, well, you touched on a really important point there, and that's that when people are looking to portray a doom and gloom story, and there's no shortage of those people around.
G'day, Steve Keen. How are you? Welcome to the podcast.
The things like building approvals are a classic because people will say, hey, look, building approvals double the long-term average. We're all doomed. But as you say, there are at least half a dozen ways in which the Brisbane market is now rebalancing itself, one of which you mentioned. The developers are just staging releases. Mirvac are doing it. The big boys in town, they do a lot of research, and they're not dumb as people
they're not
seem
cowboys.
to believe. No, that's right. Now, yes, some of the smaller time developers, they'll still continue to build because they've already decided they're going to press ahead. But you've got to, and that's why people engage someone like me, because they can give on the ground insights. You're not just saying, oh, here's a load of headline numbers that we could have found ourselves. And you have other factors that are rebalancing. So Brisbane's population growth is picking up and so on. So that's really what hedge funds are looking for. Now, I don't suppose I'd be giving too much away to say that we did a lot of work on Western Sydney, and my strong conclusion there was that if interest rates hiked or if interest-only loans are not able to be rolled over, there's going to be some pain there. Whether that is a contagion that spreads throughout Sydney, that's another question. But we did a lot of work on like-for-like resales, the change in the marginal buyer, which started to happen around 2013 with lower interest rates. A whole load of investors came in. Then we had the subdivisions and the supply response. And I think a lot of people who've spent $1 million plus in some of those Western Sydney suburbs could be left holding the baby a bit. The inner Brisbane market, I actually live New Farm. I mean, you don't really need an analyst to tell you that. You can see what's happened, and the market's going to take some time to absorb some of those apartments, and we'll see some falling rents and probably falling prices in some cases as well.
Interesting in Brisbane, the stuff that's considered blue chip on the south side near the river, having a few vacancy problems, but we've bought some stuff a bit further out, a bit further south, a bit further away from the oversupply, and it's not an issue with the rental. In fact, they need more of it, sort of a bit further out. So
good schools though. Well, you guys know better than anyone. But same way. I bought a property in Sherwood the other day. We had it on the rental market. It was rented at $1,100 a week in about 24 hours. Wow. Because good school zone, family appropriate accommodation, close to train links. And it's a bugbear for anyone who commentates on the property market. There's a rebuttable assumption that the median price growth in a certain suburb is a very important metric, but of course, that's just an average of a whole load of recent sales
built on an artificial line.
Yeah, that's
which
right.
is a suburb boundary,
a postcode. And that's even within postcodes. You've got streets that outperform property types. In particular, Brisbane is probably the patchiest of all the capitals.
How do you describe Brisbane to like a hedge fund from overseas? It doesn't have a traditional western suburbs because the river runs through it. It doesn't necessarily have a two-rack. It's an interesting city and it's got a lot of lifestyle elements to it. But how do you describe Brisbane from an investment perspective?
Yeah, it's a really interesting question because the reason that hedge funds engage people to write reports and consult to them is because they have these are some of the most intelligent investment minds, I should say, amazing money managers, but they wouldn't have the local insight to know, for example, that Perth is a resources influenced capital city, and Sydney and Melbourne are the more services-based international cities where the population flows to. I think Brisbane I would characterise as it's a city with resources influence, particularly coal. And during the boom years, obviously Brisbane was a big beneficiary of that. The good thing for Queensland, the Queensland story really is that they took the downturn much sooner than Western Australia did. The LNG projects transitioning to production, that had all really happened by 2014, and now we're coming up to 3 years where CapEx hasn't been plummeting. Western Australia even now is still got a bit to go. So Queensland has been able to fight back. Tourism being one of the ways that it's been able to do that.
Mm-hmm. So it's incredible. When you're studying, do you also do a bit of Melbourne work as well? You don't buy actively in Melbourne, but your data is there. So are you looking at that data and thinking about Melbourne?
Yeah, the reports that I write are usually Sydney and Brisbane reports because those are the markets I buy in, I'm familiar with. Yeah. Melbourne, I've never really connected with in the same way. I'm being a POM, I would never move here.
It's just like being at home.
I wanted this weather, I would have stayed home.
It was 6 degrees when I landed this morning. I don't own a jumper in Queensland. Wear short shorts to work and thongs to the office. But I think Melbourne, I look at a lot of the macro data, and you guys would have a much better handle on it than me. It looks to me that at the rate at which Melbourne is attracting people from Adelaide, from Perth, even from Darwin, and now even from Sydney, it looks to me like Melbourne's got a way to run. I wouldn't pretend to be an expert on the Melbourne market by any stretch of the imagination, very much a macro overview. But the oversupply, which I think I was probably on the public record in 2013, so there's probably going to be an oversupply of apartments in 3 capital cities. But Melbourne, it hasn't really materialised in the way that we thought. Partly as a result of that, just attracting so many people from
the absorption's been so it's surprised us too. We're actually, yields are up around 5%. So if you've got an oversupply, you would normally think that your yield is going to hit a barrier, but look, there is pockets, Flagstaff area and some of the pockets of the city area, but yeah, it is, to their credit, and we are very much an education town, and so we rely incredibly. I think where there's over 350,000 international students who are now here in Melbourne studying. So we are one of those sort of thought leader, education leader type centres, and we have a good reputation for that, and being multicultural. Now that's given us a baseline under our property market, which has surprised even me.
Pete, why bother? you love the charts, you love research, you love the detail, and yet you've got this financial freedom. Why bother go and do all this? What's the driver for you?
Well, I think when I quit my full-time job, we went travelling for 18 months, and it gave us a lot of time out from working full-time. We were both directors at Deloitte, and then we both worked in industry as finance managers in Group FCs, and it took quite a bit of time out for us to really think about what do we actually want to do. My wife decided children, and I decided to build a business based around what I was interested in. I think people often say to me, well, how do you find the time to write a blog every day? And the answer I can only give is that if you didn't enjoy it, you wouldn't do it, because you see so many people, they set up a blog page, and there's a post in the first week, and then maybe one a month later, and then it dies out because people find writing hard work or a chore. Whereas I've always enjoyed the process of disseminating information, trying to find the story in the numbers, maybe, as you said, the odd chart.
The odd chart.
I've always enjoyed that process. I think I've got an analytical type brain, and if you didn't enjoy it, then you wouldn't do it. And it's the same with business. I think it's a good principle to live by, and you touched on it at the beginning, is property investment is interesting to a point, but really you should try and find what is it you're passionate about, turn that into your business, and then it doesn't feel like work.
Mm-hmm. So but Ben and I are in the content business. It's hard to provide that constant stream of content. So is it just you, or have you got a team of people that sort of paraplan the research for you, and then you just provide the strategy and the insights, or is it all you?
No, well, it's just me. I have an advisory company that I set up as a separate company from the buyer's agency, and I've just really just badged that as my own insights. So we write a monthly report that goes out to subscriber hedge funds. I also do bespoke consulting services, because realistically, institutional investors, one is not like the next. They'll have different needs and ideas. But it is me doing the work, so you've got to charge properly for your time, because there is only one me. I should also mention I have another company which is a financial education company, and we're putting on a seminar in Sydney on October the 7th, so I better get the plug in there before I forget.
Right.
Yeah, come along if you're in Sydney, October the 7th. It's the Money for Life workshop with Stephen Koukoulis and myself and a number of other highly respected financial experts.
What about us in Melbourne? How are we going to get
have to fly up there, do we?
No, that's the idea is that if the Sydney one is a success, we will replicate it in Melbourne and Brisbane as well.
Fantastic. So we'll get that in the show notes, so check that out, and the link to book your tickets for that.
What is that? You talked about you had that financial freedom at the age of 33. What does that look like? Is it a passive income stream? Is it an equity harvest stream? Is it somewhere in between? Just for the benefit of the listeners who are trying to replicate your success.
Yeah, but I mean, it's different for every person. But for us, I think, as I said, I was more of a share investor in the first instance. But like a lot of people who get into property, you very quickly find you end up top heavy with the property because of the leverage that you use. Now, like a lot of Australians, I was a bloody genius in 2006 using margin loans. I was making money because I worked in the mining industry for a few years, and I was making an awful lot of money on mining exploration companies and all sorts. So obviously a few lessons there, never meet a margin call, but in particular, and this is something that property investors should think about, if you've had some great successes, either take some money off the table or think about your downside risk. But to answer your question, for us it was an equity target. I think it's different for every person, but I always say to people, if your end goal is a passive income stream of, let's say, $150,000, then $3 million of equity, broadly speaking, is about the number that you could. If you get to that level, then you know that you can convert that equity into a passive income stream. Now, as I say, we've never sold property because we just didn't want to draw the capital gains tax, but also because we've got kids and we want to pass our
legacy,
investments on.
pass it forward.
Going into business was a way to develop more passive income, and I think that's something that people don't always touch on. They've gone into business for the goodness of their heart and for the philanthropic. I can't even say the word.
Philanthropy.
Yeah, that's right. But for me, it was as much about rebuilding an income stream to replace my full-time income, because share investment in Australia is very generous with the franking credits. But you do find particularly if you've got a portfolio of Sydney and London properties, you're probably topping up. In the early days, at least, you're topping up some of those investments because the cash flow can be negative.
Is there a debt retirement strategy as part of this for you as you're building it out, or it's just equity harvest is the way for you?
Well, we partly as a result of the growth in the market, we at the end of each financial year, we just do a quick balance sheet, and our LVR is actually below 30% now, and that's as much as anything else just because the London and Sydney markets have gone gangbusters. Last year we moved a number of mortgages to interest only and locked them out for 5 years. But we have several mortgages now which are paying down. So the idea is to clear those off as quickly as possible. So look, there's any number of strategies that you can use as an end game. But I often say to my clients, well, if you can get to that equity figure that you want to achieve, you've got all the choices in the world, but you've got to get there first to give yourself those options.
Yeah. And it's so true. I mean, again, we've talked about this before on the podcast, but if your portfolio has a gearing ratio of 50 or 55%, even higher with these low interest rates at the moment, it's cash flow positive. Unless something is drastically going wrong and you've got friends in each of your properties and you're letting them get away with 2% yields. But the reality is so you're at that accumulation phase, you finish that off, it's now about the debt retirement. So at 30%, Pete, you'd be, there would be a reasonable acceleration on some of that debt retirement. And, you're still young, so the longer you hold on to them, these are geese that keep laying golden eggs, and that's a powerful thing, isn't it?
I'm not that young, I should say, but
how old are you, Pete?
I'm actually 40 this year. So
wow, wait a minute!
I need to update that bio. It's a bit out of date. But no, it's a good point. I mean, the property that my wife bought in Cambridge, that was a repossession property in the UK. It went through a recession in the 1990s, and she bought it for £68,000. And obviously the mortgage on that now is minuscule, refinanced it a few times. But you do find that if you own property for long enough, it just throws off cash. And you can't even imagine that when you buy it. Because at the time, Heather's grandparents were mortified that anyone could spend £68,000 on a because obviously that's close to London, it's the expensive part of the UK. But it's just in the same way that people can't imagine that Sydney house prices will be higher in the future, but just look at the numbers from 1960, 70, 80, they will be. That's just the way it goes.
Can I highlight a point there, Ben? It was a throwaway line, but if you hold it long enough, it throws off cash. There's a consistent theme for people if you hold it long enough, and that's we've talked about Warren Buffett's got a very large percentage of his wealth after his 50th birthday and a significant after his 60th. But for people who are the question is negative gearing still worth it? Is investing in property still worth it? The answer is if you're playing the long game, absolutely. Yeah. It's absolutely still worth it.
Probably add a caveat to that, and that's that you should always. I know yield is important, but one of the lessons I learned is just buy the best located property you can afford, because the capital growth on those types of properties has just been phenomenal, like 400% or 500%. But you do find that the rents then play catch up as well.
They do.
So even though it might not be a, let's say, yield property in inverted commas, but the income is different to the yield, and the income over time actually grows and compounds as well.
Because renters want to live in the same locations that owner-occupiers want to live, so you can get that premium. It's still a market, isn't it? Whereas some people do get caught up in that, Pete. They get seduced by the 7 or 8% yields in these sort of semi-arid mining towns, and think that this is going to be indefinite, and then it just stagnates, or the value drops, or worse. Whereas, you buy a property for $400,000, and 20 years later it's worth $1.2 million, and you're getting $900 a week rent for it. It's like, well, that's just playing the game, and it throws off the cash, like you were saying.
Throws off the cash.
I like that. Yeah, I like that one.
Is the queue in the rack, or are you just strategically picking up more along the way as you go along?
Look, we actually just bought a place, just settled on it a couple of weeks ago in New Farm. So I guess we'll keep on buying it. I think that will probably be it for a little while because we're just about to start a project in the UK, which is the biggest that we've done to date. So a 4.5 acre block that we're developing there with a pretty large house, so that will keep up.
We as in you and Heather?
Yes, yeah. So that will be keeping us busy for the next 18 months. We've got a project manager in mind, but that's the biggest single project that we've done.
Bit of farmland, going to be farmers, Pete? Going to be farmers.
Yeah, I think that would be nice, but you actually have to show you are farming to claim to tax
Buy a couple of sheep out the back.
I'm a chartered accountant. I don't do that.
Plant a few tomato trees. So where do you plan? So you're about to turn 40. Where do you plan to spend 40 to 50? Is a bit of time in the UK, or are you predominantly in Australia?
Yeah, look, the last 3 years we've spent 6 months in the UK and 6 months in Queensland. I think there's a lot of opportunity. Southeast Queensland, that whole strip from Noosa down to the Tweed, that's going to be a real population growth hub over the next decade. I think, as you know, Perth will make a comeback sooner or later, and that is appealing to me because it's closer to the UK. There'll be direct flights coming in, but I think I'll be based mainly in New Farm. I love living around there.
Yeah, that's great.
The only place that could probably tear me away would be the sunny coast. I've been up there this week, we split our time between England and Australia.
Mm.
That's fantastic that you've built your lifestyle, your work around the lifestyle and the job and your passion. So real credit to you. In terms of the getting from the macro to the micro, have you ever had that paralysis by analysis, or have you been able to sort of work your way through that? I mean, very early on in my sort of mid-20s, I always used to want to get the numbers and want to, it's a big investment. I wanted to make it. I wanted to pick the best property I could ever buy. To what I am now is like 8 out of 10, good enough for me. What's your story there around bringing the big data down into the micro?
Yeah, I must admit, for myself, I never had a problem with it. I was always happy just to buy quickly. As you know, when you become a buyer's agent, there's a different duty of care there.
Totally.
Having made a lot of the mistakes myself in the early days, and also gave me a good education of what can go wrong. Murphy's Law, if something can go wrong, it will eventually. But yeah, it's never taken me too long to buy a property. If I get pre-approval, I just get it used. But I do know, and you will know from some of your clients, that sometimes people are looking for that silver bullet, the perfect strategy, which doesn't exist. And it's
and you're moving 3 suburbs out by the time you actually execute 18 months later. Yep, you should have grabbed that one we told you to grab.
Yeah, that's right.
You should have got the 8 out of 10 one.
You should have got the 8 out of 10 one.
And that's why the Sydney boom becomes self-fulfilling, because people start thinking, gee, if I don't buy this month, next month I'll be paying 10 grand more, and then the next month, and then it builds on itself.
Pete, I always think that I'd pay as much money to go and listen to a seminar where someone's authentically telling us how they stuffed up as much as what they did successful. So in what you've seen, where have been the horror stories? What have you seen people do? What's some of the mistakes you've made? What's some of the stuff that you just would love our listeners to learn from? Just don't do this, or don't do what I've seen.
Yeah, I think in the share markets it was very much I was in the mining penny stocks, the penny dreadfuls, because every man and his dog was making big money. But looking back, that was just pure price speculation. It wasn't based upon any fundamentals. Mining companies with resources, but never having mined any of it out of the ground.
But let's be honest, Leonardo DiCaprio made it look so easy in The Wolf of Wall Street. Come on, it can't be that hard. I think,
I think that taught me you have to think about the downside, but also, particularly since 2007-8, I've completely changed my strategy now. I just buy assets that I just think, if I live to be 110, I'll just that I never have to sell. And that's the same in the share market. So I go into the big, I won't name them, but I listed investment companies with nicely diversified portfolio, industrials, financials, those kind of companies that just keep on paying you the franked dividends, and you're just compounding. And you might not maximise your return, but it's great peace of mind. So I think, my biggest mistake, no question, was share market speculation, which a bit like when you go to the casino, you almost have to have a bad day to realise that this is a really bad idea. Very similar. In the property market, I mean, really, Sydney and London and Cambridge, those markets are very forgiving over the long term. I mean, I've probably overpaid, by $5,000 here or there. Bought properties with special levies that were raised and so on. But, you live and learn with those things. But I think, taking action in those markets has generally been a good decision.
How many properties are in the portfolio and across the globe?
In mine? We have 9 properties. So, in property, and you guys as strategists know this very well, the property investment, it's not a pissing contest where the person with 12 properties is better than the person with 11 properties.
Exactly.
It's all about the value.
It is, and it's also about your own risk tolerance, what your own goals are. As I said, our LVR now is very low, and we could obviously ramp that up, but I think we're trying to, not necessarily very successfully, but trying to rebalance towards UK shares and so on. To try and balance out the portfolio. But I often say to people, it really isn't about how many properties you own. It's about having high quality assets that you're happy to hold on to for as long as possible.
That's right. I mean, the value of those 9, whatever it may be, could have probably got you 1,400 properties in Detroit, as an example. So, you could buy 30 properties on a credit card back in the GFC. So that's a perfect example that it's not about the number, it's about how it's doing it. And it's interesting that you are paying attention to potentially rebalancing it. So you're assessing risk and you're potentially saying to yourself, okay, there may be an opportunity in the cycle of the market with Brexit and the currency that might be paying some favour. So you're sort of saying, okay, bit of an opportunity over here. So I'm going to look at that for the next 5 years, and I suspect you'll pivot again as you see the need to.
Yeah, and the other thing, if you have a very large portfolio of properties, then you introduce a whole new range of headaches into your life. I would much rather have one harbourside property in Sydney than half a dozen out west. It's different strokes for different folks.
It is.
We've always worked on the principles that that those are the types of areas. In fact, we even lived in some of our properties along the journey and then rented them out later. Those are the kind of areas like Bondi, Pyrmont, Erskineville, those are the kind of areas that people like us want to live, then they're probably going to be pretty good. As you said, you might not pick the best suburb or the best property, but they will do quite well over time.
I think your core point before too is you said that once you get that net 3 million, that's the game. Once you can be net 3 and ideally debt free, but not always. It doesn't matter if it's 12 properties, 20 properties, 100 properties, or 4 properties. That's what people often forget, that's what we're aiming for, because then that provides the freedom and the choice and the lifestyle and the energy and the passion, that everything that comes from not having to trade time for money. So.
Any exposure in off-the-plan, higher density stuff and any views on that?
Or what you've seen from clients as well?
Yeah, we've done it once. I wouldn't, personally, I wouldn't do it outside Sydney in Australia. I know people do, and sometimes they make money, but
they do.
Yeah, look, it's not really for me. I've seen too many people lose money, particularly in Brisbane, two-tier pricing and people from interstate. I mean, Queensland has a long history of attracting interstate money.
If anyone turns up in white shoes, run a mile. Run a mile.
You don't have white shoes, do you? Any sort of books that or podcasts that clearly the Property Couch, but any books or podcasts that you like to tune into? Where do you draw your inspiration from for a lot of the content that you have to provide and sort of stimulate your mind? Yeah,
Devils and Details is a great podcast on Business Insider. It's not just property; that's the economy, share markets, you name it. Books, well, there are so many. I think if you, in terms of just general life advancement, I've always loved the Tony Robbins book, Awaken the Giant Within. It's like a how-to manual for living your life, setting goals, reviewing your progress, how not to think negatively. It's the sort of book you pick up, and even if you're a despondent when you pick it up, you can't help the relentless positivity. It just rubs off on you.
Agreed.
Last one for me, Ben.
Yes.
Do you know when you start on a journey and your mindset is here, and then when you go down the path and achieve what you've achieved, your mind gets expanded? What's been the biggest change in your mindset from when you kicked this off with your wife Heather to where you stand now that the listeners can benefit from?
That's a very challenging question. I think the thing that's just it was like a lightning bolt for me is just understanding compounding, and not just property, not just finance, but just how it works in the world in business. If you can combine compounding with get some leverage, and then if you can start to use some of those other techniques like the 80-20 rule to really streamline your approach, I mean, what you can achieve is really limitless. I was coming very much from an employee mindset as an accountant. You go to work 60, 70 hours a week, making me cry just think about it. But trading time for money. And that's certainly since coming away from the full-time environment, just understanding some of those principles, it's just less, as you said, it's such an eye-opening concept, and that's what we're trying to pursue now.
And you've taken action. I mean, one of the, here's a person for the listeners who has walked the path and is willing to share that, pass that knowledge on, pay it forward through the books and also through, the courses and the events that you're putting together. And it's good content. Like it's content that hasn't got an agenda attached to it other than to raise awareness and empower basically the people that you're educating.
I think one other thing that I would probably we should have mentioned there as well is that everyone, it doesn't matter whatever your strategy, whatever your goals are, you'll have at some point you'll get setbacks. It's just that's a given. So whether or not you're successful in life, in investing, it's not really necessarily about doing the right thing all the time, but it's how you respond to the setbacks. If you can bounce back from those, then you can be successful. And so it's really how you respond to the setbacks. That's what determines your level of success.
I heard some great advice. Ben and I went to ARIC, I've mentioned it before on the podcast, where business is constant white water, in terms of you're not out with the waves getting smashed, and it's not clear water, it's often white water because things are happening. And I think for people who want to achieve some form of success or achieve better than the status quo, if they have that paradigm that life can be constant white water, there's stuff that comes up that you need to face and overcome because you're trying to do something that not everyone's prepared to do. I think that'll set you up well going forward to know that, because if you're running around constantly looking for that clear water, then you're setting yourself up for a bit of disappointment. So, but I think that's a consistent theme. So, which is good. And before we sign off, Ben, of course, just a little shout out. We are going to do a Facebook Live next Wednesday, 4th of October, 7:30 p.m. Australian Daylight Saving Times.
You should be a rapper.
Did you see that?
I got all the,
I was just letting you know, 7:30.
And how do they remind themselves? What do they do? Go on Facebook?
Go to Facebook. It's easy. Just go to our Facebook page. It'll all be there while you're there. Like us.
Perfect.
And we'll give you all the updates.
And we'll see you next Wednesday night.
Next Wednesday night. On the couch, Ben.
On the couch.
You see there's some space on the couch. We've got someone who's going to join us. All right, very good. Ben, my life hack today is... Did you know? Is that patented with Ben? But
no, go for it, mate.
Did you know that
poetic license?
Do you know that if you're using Google Maps,
yes,
and let's assume that I need to see the map. Do you know that I could go? Let's just call it Fiji, for example.
Yep.
I can pull up the map on my phone on Google Maps, and of Fiji. Then I can type in the address OK Maps. All right, OK Maps.
OK Maps.
As soon as I do that, it'll prompt me to download the map to my phone. Why is that important? What if I don't have signal? What if I don't have internet connection? I can still use the map around Fiji totally because I've downloaded it.
Where does it go? It goes into your wallet?
Wow, mate.
Your phone
wallet? You been looking in my wallet? No, it just
goes into the technical wallet. No,
it goes into the memory of the app within the Google Maps.
Oh, okay.
And then but if someone's planning a trip to the desert, Ben, and they just they go, Google Maps will sort me out, and then they realise there's no signal out there. If they pre-frame that, they put the Sahara Desert on their map, they push OK Maps, download it. How good is that?
Probably won't know which way north is though, mate, so they'll probably just keep walking towards the sun.
So that is my life hack for today, folks. Try it out. OK Maps.
OK Maps.
And it stores in your phone. It'll download. It'll take up a bit of memory, but there you go.
Love it.
Now, Ben, before we get to Did You Know, well, actually we are at Did You Know, but we've received this from Jen Ivers.
One of our listeners.
# world record, # Did You Know. Ooh. So,
I'm loving it already.
Jen says, I found your podcast a fortnight ago and I'm now 67 episodes in. Is that a record? ? I worked it out. It's 4.8 episodes per day. What a woman. Quote, unquote. quote.
What a woman, all right. That is hardcore.
4.8 episodes of you and me per day. That person needs a medal.
They need more than that.
The footy banter, me tripping over being...
Yeah, we don't talk footy at the moment, do we?
No.
Okay, here we go. Interesting facts. We
Did you
ready?
know?
Here's a did you know? If someone found a way to extract all the gold from the bubbling core of our lovely planet, they would be able to cover the land with a layer of gold up to your knees.
Fair dingham.
So that's how much gold is in our core.
All right. Let's start getting mining.
So obviously there's a bit of ocean there. So it wasn't about covering the ocean as well, but all the land
it's just
mass,
the land. Okay.
the land mass on the earth up to your knees.
Wow.
That's a fair bit of gold.
Yeah.
Gee, I thought they were all in the banks of the US and China. But anyway, we move on. 95% of people text things that they could never say in person.
Ooh.
We're done. Bye-bye.
Hey,
Whatever that one, that's an interesting one. And let's end up on a high note.
All right.
Did you know crocodiles can't poke out their tongue?
I didn't know that,
You
mate.
did
I've got to
not
be
know
honest.
So if you ever get near a crocodile, don't ask him to poke out his tongue. Poke him in the eye. He'll let you
how
go.
many listeners didn't know that either. Too. So terrific stuff. Of course, if you want to join the conversation at the Property Couch, at Bryce Holdaway, at Ben Kingsley AU, and if this is the first time that you listen to the podcast, you're in for a treat.
You are.
Because we've got some awesome gold.
Yes.
But feel free to go back to episode 1. Start from the beginning. It's foundational. It all builds. And to get through it quickly and maybe knock Jen off the record of 4.8 a day, Ben.
Well,
do it at 1.5 speed. I wonder if she did that at 1.5 speed or 2.
Let's hope she did it at 2.
Let it, write in and let us know, Jen.
That's sort of nosebleeds.
And of course, if anyone's got any questions that Ben and I, because we've just come off all guest last month, Ibis, it was terrific, but we're going to get to some more Q&A, Ben.
We need
so
to.
If anyone wants to give us a question that they want read out here on the podcast.
Or audio, sound it out.
Well,
don't forget.
You beat me to it, mate. Just go to the website, go to the little widget at the side, leave a message. You will hear your voice. This is the People's Podcast. You will hear your own voice on this podcast, and we will answer your question, which is terrific. But again, Pete, it's been terrific for you to come on, share with us all your wisdom.
Safe travels.
Yeah, enjoy the UK, and again, we'll have to get you back on and share some more of those charts, Ben.
Love it. Love a good chart.
And if anyone wants to catch up with Pete, we'll have all of his contact details in the show notes. But until next week, Ben.
See you later. Oh no. Knowledge is empowering, but only if you act on it.
I
do it every time.
I know. See you later.